60-40, is this 60 now bonds?
We could see a period like that going into next year, right? So if things are indeed, if things are going to decelerate off a very, very high base, then probably, maybe not second half of this year, we don't think we'll see a lot of rate cuts yet, but maybe going into 2024, 2025, the chances of rate cuts get bigger. And as people get more worried about signs of recession, and maybe when payrolls go negative in the U.S. from a very high base right now of 200-something thousand, et cetera, then at those points we do think that certainly bonds will have more room to rally. But probably at the beginning of that period, before you see that massive compression in terms of yields, in terms of Treasury yields, you will actually see the expansion of credit spreads first. So that might be a better time to engage rather than position heavily at the moment.
In the meantime, what's your biggest overweight?
We actually think that there's not likely to be a very sharp recession this year, and therefore probably not the interest rate cuts that the market's pricing in. And in the scenario that a recession is mild or delayed, probably we think that the outperformer this year is going to be Asia, China, emerging markets. First of all, you do see that in these economies you have later reopening, and therefore some of the sequential improvement in economic momentum versus in U.S. and Europe is kind of sequential decline or deceleration. Secondly, there's really no inflation in these markets. So actually the policymakers, flexibility is much better. And actually if they wanted to loosen in terms of credit or other things, then there's probably still more room. Thirdly, clearly, we don't think that the U.S. dollar is going to be nearly as strong this year as what we had seen in the previous years. There could be a little bit of a bounce in the near term, but if the U.S. dollar is in a broader weakening trend over the coming quarters, then that's actually going to be very positive for the Asia and EM markets. So those are the areas that we think can actually have much better performance this year and where we would be, focusing more of our attention.
The Federal Reserve here, of course, expecting soon next week another quarter point, 25 basis point cut. But how much of the heavy lifting is now being done by banks, particularly regional banks, as they put the drawbridges up and increase the sort of hurdles you've got to get over before you can get a loan?
Well, I think that's something that's starting to play out, right? I think it's a dynamic issue as well. Clearly, if you continue to have a lot of outflows and you're not really sure how much liquid assets and capital you're going to have, then you're going to have to be a little bit more careful about how you extend the loans, et cetera. So that's just starting to work itself out. And I think unlike the European situation, which people mostly view as a Credit Suisse specific type of situation, in the U.S. it's not just about one bank, it's about actually a whole type or a whole category of banks, or it could even expand to new banks that haven't been impacted so far. So I think that is something that the Fed needs to watch carefully. But on the other hand, if you think about it this way, if you have a problem, you need to tackle the problem straight on rather than just throw more liquidity at the overall market, right? So that's why I think they're still likely to raise interest rates in May. But I think what the market's going to be watching much more carefully is not whether they hike in May, which has now gradually gone from like 20-30% market expectation now to 70-80% chance again, but rather what they say about subsequent, right? Do they say this is it and we're going to pause here, which I think is less likely, or do they say actually it's still all data dependent? So if they say it's still more data dependent because the market's now pretty much expecting a rate cut as soon as June or July.
Right.
If they say it's data dependent, that means there's definitely no rate cut soon, right? At best, there's a pause. If that happens, then maybe, some of the volatility that we talked about earlier, which has been super low recently, might pick up. So I think that's what people are going to be focusing on. But I think the Fed is right to focus on the broader picture about the slowdown of the economy and the slowdown of wages and, see how strong is payroll, which is still very strong, by the way, rather than to say we're just going to throw a lot of liquidity and pause QT and stop hiking rates and maybe even cut rates. That doesn't solve the specific problem.